reconvene here, and we'll call this the Public Finance and Policy Subcommittee of the House Ways and Means Committee. Mr. Chairman, did you want to welcome us and give that? I think you have a similar audience in terms of your membership. Do you wish to go over the rules of the committee again, Chairman Blackman?
No, just since it's the same members of this subcommittee as the other one, we can forego that. We'll list them again tomorrow. So
Okay.
Thank you, Chairman.
Thank you. Ladies and gentlemen, we have before us one item today, HB 149. That's HB 149 LC 43 1869S. Secretary of the Majority Caucus, Representative Williamson, please.
Thank you, Mr. Chairman, members of the committee.
What number are you on? The white mic, 7.
Number 7. Thank you, Mr. Chairman, members of the committee. I'm here today to bring before you a committee substitute to House Bill 149. It's LC 431869. And quite simply, this bill allows pass-through entities that are organized as business entities in the state of Georgia to be able to pay their state taxes at the entity level. The net effect of this would be that you would have less earnings hitting the K1, which goes to the, for example, if it's a multi-member LLC, the K1 received by any given member would end up having to pay less federal taxes on the reported income on the individual tax return. So thereby you enjoy a savings of your would have otherwise been due federal taxes. Quite early, the question came up as to whether or not the federal government was okay with this, and Chairman Carson happened to help me do some research as well as other individuals, and in fact that is addressed under 26 U.S. Code. I guess it's Chapter 1363, and it is acknowledged and an approved practice by the IRS, and so therefore. Several states around the country have already adopted this code, and I believe in, as I understand it, Connecticut, or this methodology rather, and many other states have this bill or very similar iterations of this bill working. That's the essence of the bill. It will not increase. It will not decrease the taxes collected by the state of Georgia. In fact, DOR can confirm this, but because pass-through entities typically have their tax returns due March the 15th, as opposed to the individual's tax returns due April the 15th, it will actually move up the cash flow as far as getting the money in more quickly to the state treasury. And again, it's revenue neutral to the state of Georgia, but I'm happy to answer any questions.
Questions?
Well, does the sub-S corporation still have to pay the taxes and all the federal taxes on the corporation?
If you remember, the sub-S corporation distributes K1s to each one of the shareholders in that case, and it's very similar terminology, but an LLC is technically members. S corporations are shareholders, but in the S corporation illustration you're given, each shareholder will receive a K1. And they would be the individual shareholders would be responsible for paying the federal taxes on their own individual tax returns. And I forgot to stress, this is totally by election only. You do not have no pass-through entity, be it a multi-member LLC, like Vice Chairman's business is organized, or S corporation, as many other business owners use, have to. You voluntarily choose to include yourself in this taxing methodology.
Okay, thank you. Chairman Carson, I know you need to just find a microphone so we can.
Here we go.
No, you're good. I just wanted to address Chair Larry Houston's comments in regard to why are we doing this? This bill is being brought forth in a number of different states, mostly, Penny, because of this IRS notice. That IRS notice is IRS 2020-75, issued November 9th of last year. And you can see, I'm just going to read the purpose. I'm not going to read all 12 pages of this, but Thank you, Mr. Chairman. This notice announces that the Department of the Treasury and the IRS intend to propose regulations to clarify that state and local taxes, so SALT taxes as known in the IRS code, imposed on and paid by a partnership or an S corporation on its income are allowed as a deduction by the partnership or S corp in computing its non-separately stated taxable income or loss in the taxable year of the payment. Penny, I had the same questions as you, but once I found this IRS notice that these regulations are coming and state law is being changed in a number of different states, not just with Secretary Williamson's bill, but a number of different states, that the IRS is allowing this deductibility and other states are accommodating this, as well as the state departments of revenue are moving forward to allow receiving these tax payments from, ironically, the pass-through entity rather than the individual. I became very comfortable with this bill, and that's why I'm a co-sponsor.
Thank you. You need a copy of this. You have a copy.
I have one other copy.
Well,
You can have this one.
just to restate that's what they refer to in your trade, I think, Chairman Carson, as the IRS issuing a safe harbor acknowledgement of organization like this, correct? Yeah. So it is safer. I have one quick question. I know we're time, but how would this impact if today, if you had a sub S or an LLC and you had, I'm just going to pull, it's 5 members and 4 members lived in Georgia and 1 lived in another state, they would now all pay taxes at their respective place? Or am I right in thinking that the member, since the money was earned in Georgia, even if the member was living, say, in North Carolina, they would owe Georgia taxes on their portion of the K-1? Is that correct?
Let me make sure I state this. It disallows electing S corporations a credit equal to the entity level taxes imposed by other states. So let's say that, I don't know, you have a tax, a member or shareholder living in California, high tax state, and there's no offset of what that member pays there against this. So as far as the best of my understanding, then yes.
I know it won't have a negative. I could get with you after because it's here. I know it won't have a
Well,
negative impact on our my question is it might actually have a positive impact on some of the revenue bringing.
Well, that's
brought
why I
into
gave
Georgia.
that example, but
Right.
is DOR online?
I can get with them offline.
Well, I'd like to get
Okay.
the question answered. This is a hearing only. Is
Uh,
John
Yeah,
Foster
Chairman, this is John Foster.
We can hear you. Go right ahead.
Okay, so I think the question is, how would a non-resident be taxed under this bill? And what the bill does is tax the S corp or the partnership essentially just for the Georgia income. So, and that's what a non-resident would owe. So if, let's say, 25% of the business was done in Georgia, the non-resident would normally pay tax on just 25%. And so what this bill would do would be to tax the entity for 25% of the income. The non-resident, depending upon how their state was set up, may be eligible for a credit or a deduction at their state level, but they wouldn't be entitled to any credit for anything paid to California. So does that answer your question?
Yeah, it's a little bit different, but we're pushed for time here, and this doesn't take away from the bill at all. It's just more. I'll sound this and then get with you offline. Assuming today we don't change a thing, I have 5 members. All the business is done in Georgia. All the business is done in Georgia, but I have 5 members own equal portions. One of them lives in North Carolina. Today, all of that tax would be due in Georgia. So the North Carolina K-1 would just owe Georgia taxes because part of their income was earned in the state of Georgia. Is that correct?
Yeah, and the current bill would tax them on 100% of the income if all the business was done here.
Right. And it would still do that under this bill.
Correct.
Okay.
Correct. Yeah.
That was the crux of the question. Thank you very much.
We'll let him go. John, you still online?
Yes, sir.
So my question is, and we have failed to talk about this, I failed to ask you about it, but am I not correct in my statement that I said that since pass-through entities in income tax returns are due March 15th, that this theoretically should get money in faster to the state treasury, again, with in a revenue neutral manner, comparing it to the current taxing methodology?
I think generally that statement is correct. I mean, instead of the tax being paid on April 15th, it would be paid on March 15th. I mean, the bill does also provide that the entity that makes the election has to make estimated tax payments. And even those corporate estimated tax payments, the last payment is due in December instead of January. So we would also, for that last payment, it would also be accelerated. So does that make sense?
But it's my understanding, since electing, the way we have the bill worded, electing S corporations and partnerships are exempt from Georgia withholding taxes. It'd still be paid by the individuals.
Can you rephrase the question?
Okay, so let me make sure I'm finding the right section. I thought the chairman was waving at me. Bear with me 1 minute.
Let me explain, those that are watching, what we're doing. Chairman Stevens is normally the chair of this subcommittee. I have another engagement, as does Chairman Blackman, with the Committee on Election Integrity at 2:00. So we're going to step away from that, or I am, and I believe you're presenting the bill. So I'm going to turn this meeting over to the normal chair of the subcommittee, Chairman Ron Stevens.
And if I may briefly, Representative Williamson, just state that unless there is objection, and I don't sense that there was any, but just let you know the posture that we're in. Chairman Stevens had a bill in the prior subcommittee that he was unable to be here in time. So we are going to shift and allow him to present his bill during this subcommittee. Again, if there is no objection. And sorry, thank you, Representative Williamson.
Okay, we still back to my bill.
Back to
discussing
your
it.
bill
Okay,
now.
Since it is a hearing only, I think it's important we get some of these questions answered. Mr. Foster, I'm just going to kind of restate on section 6 of our bill that we're going over today. It says said chapter is further amended by adding a new subsection code 48-7-129 relating to withholding tax on distributions to non-resident members of partnerships, subchapter S corporations, and limited liability companies, to read as follows. And the new code reads, this code section shall not apply to electing subchapter S corporations as defined in paragraph 7 of subsection B of code section 48-7-21 and electing partnerships as defined in the code section 48-7-23. And my understanding is the net effect of that would be that it was going to exempt, make it clear that it exempts electing S corporations and partnerships, obviously, which would be LLCs, from the responsibility of Georgia withholding taxes imposed on out-of-state shareholders and partners. So I just want to clarify that fact.
That's true. And I think that's a good point. And the non-resident withholding wouldn't be required because the entity itself would be paying the tax. But kind of getting back to your comment about accelerating the payments, the non-resident withholding is normally due on the due date of the tax return without extensions. So normally due on March 15th. So this bill now, if you read the section or two before that, unless you read the language, you won't get what it means. But what it does is require them to make estimated tax payments, and estimated tax payments are made throughout the year. So just sort of a further confirmation that it will have the effect of accelerating the payments. So good point. And something I hadn't thought of. Does that answer your question?
It does. It clarifies that for me as well.
Any other questions? Yes, sir.
John Foster still on? John Foster, John Carson, I've got a question in regard to from the administration of this bill. Are you there?
Yes, sir.
So if I'm just going to say I run a funeral home and it has an EIN number, and I currently pay my taxes through a K-1 for my partnership with that funeral home, and my taxes are recorded as individual tax payments under my GTC, under my social security number. So under this bill, if I have a funeral home and I elect to make estimated tax payments to the Department of Revenue from the funeral home S Corp, how does the Department of Revenue know not to further ask for tax payments from the individual's Georgia Tax Center account as well? Do you follow?
I think I do. And the way the bill is structured, it allows, and I'll see if I can point to the line. Let's see. If you look at lines 20 and 21, what it does is the payments that the S Corp makes themselves are not going to be, in a sense, transferred to the shareholder. But what the shareholder is going to do is to not recognize the income. So the shareholder, if the let's say it was, and this wouldn't be the case, but just to make it simple, one shareholder, well, I guess actually it could be the case in the case of an S Corp, but one shareholder and the entity makes $100. It's all earned in Georgia. They make the election. They pay tax on the $100. Then when the shareholder goes to file their return, they're going to then back that $100 out of their federal AGI. So there'll have to be a line put on the return where that shareholder is going to exclude that $100. Does that make sense?
Yeah, I think so. I'm just working that through that mind. So there would be an additional line on the 500 or not on the 1040, right?
Well, it'd be on the 500.
On
So
Schedule 1?
yes, it'd have to be on Schedule 1. So, does that answer your question?
It does. Thanks, John.
Okay, sure.
Any other questions? Hearing no other questions?
I believe we have a couple of people that that signed up on Zoom that wanted to comment on the importance of this bill.
Yes. And first one is Aaron. Are you on?
I am indeed. Good afternoon, Chairman and members of the committee. I just want to thank Representative Williamson for his leadership on this and for the committee's hearing of this important legislation. As the representative indicated, this is an effort that has been undertaken in a number of states as a result of the 2017 federal tax bill that essentially raised taxes on small and Main Street businesses. So this is an opportunity for Georgia to be able to take this matter up and provide a meaningful tax reform and relief to many of the S Corps, LLCs. They're all organized as your Main Street businesses and give them a tax break as a result of it. So I'm here on behalf of Redwood, Allegis, and Maxim companies. Together we employ about 11,500 Georgians and have a substantial investment in the state of Georgia. And we look forward to continuing to grow our business there. And we really thank the committee for considering this legislation. And I'll rest and answer any questions you may have. Thank you very much.
Okay. Brian, are you on?
I am, and this is Brian Reardon. I'm the president of the S Corporation Association. This whole issue, we call it SALT Parity, is something that we've been working on since, before tax reform was passed. Actually, when the Senate was considering this bill, it became apparent that where C Corps would continue to be able to fully deduct their SALT, S Corps partnerships would not. And, you know, as was described during the hearing here, the new rules are if the entity pays the tax, they can deduct it as a business deduction, a business expense. If the individual owner pays the tax, then it's subject to that new cap. So we've been active in many of the states that have already enacted the SALT parity reform. There's 7 of them so far that have done it, including, I think the most recent was Maryland. We did the bill down in Louisiana. Tom Nichols, who I think is going to testify here shortly, wrote the Wisconsin bill. And then we're active in about 15 states now, including Virginia, South Carolina, North Carolina, Alabama, Arkansas, and many other states where we fully expect these reforms to get enacted in those states as well. Super excited that you guys are looking at it. The fact that the IRS has blessed this approach is a big step forward, and I think it's the reason that so many states are actively looking at the reform. Tom, he won't blow his own horn, but he's the one that wrote the legal analysis that convinced the IRS to bless this approach. So he is the expert on this issue, and I'll stop there. Happy to answer any questions, but Tom is the expert on all this.
Members on witness. Then we will go to the expert. Tom?
All right. I see if I can live up to that introduction. Can you hear me?
Yes, sir.
Okay. Well, I just make a couple of points. I know they're short on time, but I'll just make a couple of points. One is that the vast majority of closely held business is essentially run through the pass-through system. And there's a reason for that. The double tax C corporation system is distortive. It causes the closely held business owners to go back and forth, figuring out, can they take money out of their corp? Can they put money in, et cetera, et cetera. Ever since the Tax Reform Act in 1986, closely held business owners have recognized that the single tax system just works much better for them, and it's much less distortive than the double tax system. I'll make just one other point, and that is just to focus on Georgia, and that is essentially what this does is it takes Georgia's 5.75% tax, which under the current regime and under the current rules, it's an after-tax 5.75%. What it does is it essentially, because there's no deduction for it, almost all closely held business owners end up being subjected to hit the $10,000 limit under the cap, the $10,000 cap for individual state income tax and property tax deductions. Bottom line is what this does is it takes that 5.75% net non-deductible tax, turns it into a deductible tax. And essentially for a business that qualifies for the 199 cap A deduction, and won't go into detail, but there's a deduction for pass-through entities, that still knocks their net after-tax amount from 5.75% down to 4%. If there's an entity that doesn't qualify for the 199 cap A deduction, it takes that 5.75% after-tax amount and knocks it all the way down to 3.6%. Essentially by getting the deduction at the federal level, but without, since from the state of Georgia's standpoint, the state of Georgia is getting the same tax, doesn't matter to the state whether it gets it from the company or whether it gets from the shareholders or the partners. State of Georgia is getting the same amount of tax. It's just essentially the after-tax cost of that tax is being reduced by almost a third, or actually potentially more than a third, by the mere expedient of having it be deductible to the individual owners. So there's kind of a win-win from the standpoint of Georgia, the state of Georgia, and its business owners.
Clear the bell. Questions? Okay, this being, is there anything else for the good of the call? This is if I were here first, I probably would have gone with first hearing and gone with this before going the second, but I understand. This is being a hearing only, the first committee, unless I hear otherwise. So we will move on with, I was looking, yeah, the chairman's not here. Chairman's not here, so we will not move ahead with this one. We'll have a second hearing. Thank you, Tom.
Thank you.
Then the sales tax committee will come to a close and we'll move on. No, we're not. Got another?
So now I'm going to stand in, substitute in as the chairman of this meeting. We're going to be hearing House Bill 317, LC 431783. And Chairman Stevens, if you'd like to present your bill.
Thank you, Mr. Chairman and members of committee. This bill may look familiar to you. This is the lodging facilitator bill that blew out of the House last year before COVID slowed it down and basically just never took it up in the Senate. So this is not something that you have not heard before. House Bill 317 builds upon last year's marketplace facilitator legislation to improve the efficiency of collection of hotel motel taxes. As you might recall, the marketplace facilitator bill, can y'all hear me okay, or is this mask? Okay. The marketplace facilitator bill had to do with sales taxes and collecting the taxes that were due. And that's all that it did. So this House Bill 317 is identical to the bill that passed last year, House Bill 448, with the exception of the date. ACCG supports the bill, and the date is moved, of course, to July of this year. Specifically, what does the bill do? It defines an innkeeper, which is the entity required to collect the rent, hotel, motel taxes, to include marketplace innkeepers like online platforms Airbnb and VRBO that facilitates the lodging and accommodation transactions. You'll see that on line 15 through 26 of the bill. It uses the very same definition as last year's marketplace facilitator legislation in 276 that required the collection of sales taxes by online platforms that facilitates at least $100,000 in annual sales in Georgia. It requires that all innkeepers, including marketplace innkeepers, to collect the $5 tax for a transportation fee. That's on line 62 through 67. The fee currently applies to traditional hotel motel stays, and this fee goes to, again, for transportation purposes. I will point out that extended stays, campgrounds that exceed 30 days are exempted from this $5 fee. It requires marketplace innkeepers to collect and remit county and city hotel motel taxes on behalf of their host, which is the property owners, line 90 through 105. And just like last year's marketplace facilitator legislation, these taxes that are currently owed by most host owners, the property owners, but often are not collected. Host property owners would be relieved of the responsibility of collecting and remitting these hotel motel taxes. That's line 108 through 110. Marketplace innkeepers would not be liable for the tax for incorrect information provided to them by the host property owners. And that only goes to say if they're not given the right information, they shouldn't be held accountable to it. That's on line 114 through 123. The remaining changes in the bill in section 4 are not substantive and simply language only to match the definitions in section 1. Based on the fiscal note House Bill 448 from last session, the bill would collect approximately $30 million in annual statewide county and city hotel motel taxes. Again, these taxes are currently owed but are not being collected. Fiscal notes approximately $12 million to $13 million in state funds from the $5 transportation fee. Again, currently not collected. Marketplace facilitators like Airbnb and VRBO already have the systems in place to collect these taxes from the host. Since April 2020, they've been responsible for collecting taxes on these same transactions. Airbnb and VRBO collect and remit lodging taxes throughout the country, including most locations in Florida. The most efficient collection of these taxes will increase economic development and tourism. Counties and cities are required to spend most hotel motel tax revenue on tourism development and marketing, up to 50% of their locations. For example, to the chambers of commerce. House Bill 317 will create parity and with transitional hotels and motels. They're already collecting these taxes and fees. House Bill 317 will benefit short-term rental hosts by removing the burden of collecting and paying these taxes directly and shifting the obligation to the marketplace innkeeper. Essentially, this is what you voted on last year, and except for the date change.
Every time I'd like to make a motion.
So I did want to clarify that this is hearing only, as all of these subcommittee bills are. So thank you. I apologize for not having forewarned you of that
No, I
fact.
didn't realize it was here. Did we hear this last year?
We did. It passed the House last year.
But Chairman Blackman, I believe, still wanted to make this hearing only, correct? All right. So we'll honor his wishes today. Do we have any questions for the Representative Chairman Stevens? So we do have some online testimony. By the way, written testimony is online from, I believe it's hotel lodging folks. So you can see under the talking points there, I believe there's 2 letters available online. And I believe we have ACCG that would like to speak to the bill.
Thank you, Mr. Chairman. Larry Ramsey with ACCG. Chairman Stevens, thanks to him for bringing this bill. This is a legislative agenda item for ACCG that our entire membership voted to support for this year. Chairman Stevens has covered all of our points. We would appreciate your support. As he indicated, this is identical to House Bill 448 from last year that did pass the House. And then, as he said, simply got hung up on the Senate side, as so many things did with the COVID break. We would appreciate this committee's support and happy to answer any questions.
Do we have any questions from members of the committee? Hearing none. Thank you, Mr. Ramsey. So next we have the Georgia Hotel and Lodging Association. I'm sorry, the who? Oh, GMA. You didn't have it on our notes. GMA, please.
Yes, sir. Thank you. Chairman Stevens and members of the subcommittee, I want to thank you for the opportunity to appear virtually before you today. My name is Ryan Bowersox, and I'm representing the Georgia Municipal Association. Similar to ACCG, GMA is in full support of House Bill 317 and view it as an important step in continuing to modernize portions of the tax code to keep up with the changing technology. Our members appreciate this committee's support of the marketplace facilitator legislation passed last year and view this legislation as a next step in this trend. The bill would provide that the responsibility to collect and remit the local hotel motel taxes and the state fee falls upon the most capable party in the transaction, the short-term rental platforms. Ultimately, this bill would help improve the collection of these taxes and aid in leveling the playing field between traditional brick and mortar hotel motels and the new online short-term rental platforms that continue to grow in popularity. Short-term rental properties to be operated in the state of this burden. We want to thank Chairman Stevens for sponsoring this important bill. I want to thank the committee for their consideration and eventually request their favorable consideration. Thank you very much.
Thank you for that testimony. Is anyone else prepared to speak to the bill? Is there anybody speaking against the bill that we're aware of? So that being said, if there's no further questions, was there another bill we have? All right, so we'll just entertain a move to adjourn. Second, move second. This meeting is adjourned. Thank